Welcome to Deloitte Financial Reporting Updates, our webcast series for important issues and developments relating to accounting and reporting matters. Today we present Bringing Clarity to ASPE Developments. It's that time of year again. My name is Jennifer Miller, and I am your host for today's webcast. I am joined by a few of my colleagues, Deanna DeCitas, John Kligman, and Claire Grindley. A couple of items before I tell you about our agenda and introduce our speakers. In the lower right-hand corner of the screen are the webcast links, including a link to download and print today's slides, and links for webcast assistance, upcoming sessions of our update series, and archive sessions. If you have a pop-up blocker on your computer, you'll need to disengage it in order to download the slides or participate in our polling questions. For those of you who know of colleagues who couldn't attend today's live event, they can simply register at any time the same way as you did, and they'll be able to view the archive webcast within 48 hours after this event. So please feel free to invite your colleagues to take advantage of this feature. In addition, although you're on listen-only mode, you can ask our presenters content-related questions at any time by entering your question in the box at the bottom of the screen and click Submit. We'll do our best to respond to your questions and comments during the presentation. We also have interactive polling questions that will appear throughout the webcast. Again, we invite your participation by simply answering these questions on your screen. A summary of the results will be provided on screen shortly after each question is presented. Now let me introduce our speakers and discuss today's agenda. First, you'll hear from Deanna DeCitas, who will provide an update on the two major ASPE projects completed in 2014, subsidiaries and joint arrangements. After Deanna, John Kligman will provide an update on the 2014 annual improvements and future changes that are headed our way. Finally, Claire Grindley will provide us with some insights on employee future benefit implementation issues, and some other year-end reminders. This is a lot of material for a 90-minute webcast, so we'll need to keep the discussion at a high level, but we'll try to leave some time at the end for a brief Q&A session. I'll also try to ask our speakers some of your questions throughout the webcast. You can read bios of our presenters and access the agenda and technical support in the navigation area on your screen. I'd like to remind our viewers that our comments on this webcast are our own views and don't constitute official interpretive accounting guidance from Deloitte. Of course, you know, before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. And with that, we will kick off with our first polling question. Again, please remember that you have to disable your pop-up blocker if you have one if you want to take part. So our first question, do you expect your organization to be impacted by the recent changes made to the accounting for subsidiaries and or joint arrangements? The options include A, yes, impacted by changes made to accounting for subsidiaries. B, yes, impacted by changes made to accounting for joint arrangements. C, yes, I'm impacted by both. D, no, not impacted by either. Or E, not applicable. While we wait for the results of the polling question, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the whole webcast, you can credit yourself with 1 hour towards your yearly total. This applies to those in public practice and those working in industry. We do not issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of your attendance. And with that, let's look at the results of our first polling question. Okay, so it seems that roughly 40% not impacted by either, 20% are impacted, or 26% when we look at the answers to A and B. So you should benefit from what Deanna is about to explain to us. And for those that indicate they aren't impacted, I would encourage you to look closely at those changes and make sure that that's in fact true and you don't have a surprise in 2016. And with that, I would now like to welcome our first speaker for today's webcast, Deanna DeCitas. Deanna is a partner in Deloitte's national office, specializing in providing accounting services to engagement teams and clients on the application of IFRS and ASPE. Deanna has led the development of firm publications dealing with IFRS and is a frequent speaker at firm and external conferences on both IFRS and ASPE-related accounting matters. Deanna is also a member of the Accounting Standards Board's Private Enterprise Advisory Committee. And with that, I will turn it over to Deanna.
Thanks very much, Jennifer, and hello, everyone. So as Jennifer mentioned, the first topic I'm going to look at is subsidiaries and joint arrangements, essentially highlighting that there's been two new standards that have been issued this year on each of these topics, as well as an amendment to an existing standard on 3051 dealing with investments. So in September of this year, two new handbook sections were issued, Section 1591 on subsidiaries and Section 3056 on joint arrangements. Section 1591 replaces both Section 1590, dealing with subsidiaries, as well as Accounting Guideline 15, dealing with the consolidation of variable interest entities. And the reason for the issuance of the new standard 1591 was really to deal with the concern in practice that the application of ACG 15 was seen as complex and requiring significant effort to understand and apply. In addition to Section 1591, Section 3056 has been issued, which replaces Section 3055 dealing with interests in joint ventures. So this is dealing with the accounting by the investor or the party to the joint arrangement in its own financial statements. And as you might remember, currently the standard allows for a free accounting policy choice for an entity to account for its joint ventures using either the cost method, the equity method, or proportionate consolidation. And this policy choice continued a differential reporting option that had originated in the pre-changeover standards in old Part 5 of the handbook. Now, since the issuance of IFRS 11 dealing with joint arrangements, there was a revisiting of this standard, and the view was that the accounting in 3055 did not result in a faithful representation in the accounting for certain types of joint arrangements. And we'll discuss the details of what has specifically changed in the next few slides. So if you cast your eye down to the middle of the slide, dealing with Section 3051, at a high level, there were certain amendments made to the standard to clarify the scope, that it includes investments subject to significant influence, as well as certain other non-financial instrument investments, such as works of art and other tangible assets that are held for investment purposes, but does not include other investments, such as investments held by investment companies. The scope to Section 3051 was also amended to clarify that a different accounting policy choice can be made for each of the following types of investments: subsidiaries that are not consolidated, investments subject to significant influence, and interests in the net assets of a joint arrangement. And we'll review shortly what that last type of investment means. There was also guidance that was added to Section 3051 with respect to contributions and other transactions between an investor and an equity-accounted investee that's consistent with the guidance in New Handbook Section 3056. Now, in terms of all of these standards, the two main standards, 1591 and 3056, as well as the amendments to 3051, are effective for fiscal periods beginning on or after January 1st, 2016. However, it's not too early, as Jen mentioned, to start thinking about the changes and the resulting implications to your financial statements, key performance indicators, as well as banking covenants. Now, in terms of transition, early application is permitted, but it should be noted that if an entity chooses to early adopt Section 3056 before Jan 1st, 2016, it should also adopt the amendments to Section 3051, specifically paragraphs 14 through 17 at the same time, and vice versa. If it intends to early adopt the Section 3051 amendments, it would also have to early adopt Section 3056. So moving on to the next slide, dealing with joint arrangements. So this slide highlights effectively what has changed in the issuance of Section 3056 as compared to its predecessor. So some of the fundamental aspects of Section 3055 have not changed. So for example, what constitutes a joint venture? The same essential definition has been carried forward into the new standard. So it's still a contractual arrangement where two or more investors have a joint control over an economic activity, and the imperative phrase is really joint control. There is a terminology change, though. They are no longer referred to as joint ventures, but are now called joint arrangements, which would be consistent with the IFRS terminology. The concept of what constitutes joint control, which is effectively the place of a contractual arrangement between the parties to share the continuing power to determine strategic operating, investing, and financing policies of an economic activity, is still there, as is the different types of joint ventures. So as you may remember, there's three categories of joint arrangements, and I'll walk through in an upcoming slide what each of those are more specifically, but they fall into the three broad categories of jointly controlled assets, jointly controlled operations, and jointly controlled enterprises, and those are still recognized and their definitions preserved in the new standard. What really has changed is, though, the accounting for those interests in joint ventures. So currently, there is a single accounting policy choice made for all interests in joint ventures. So an entity can account for them under the cost method, the equity method, or using proportionate consolidation, whereas under the new guidance, the accounting method will depend on the type of joint arrangement, be it jointly controlled assets, jointly controlled operations, and jointly controlled enterprises, with a view that where an entity has rights to assets and obligations for liabilities, as is the case for jointly controlled assets and jointly controlled operations, they would need to be recognized in the financial statements. But there is some options that are still being afforded to jointly controlled enterprises, which is not dissimilar to the options that are available in terms of cost and equity in accounting for certain subsidiaries. The other change that was made, which is more in the nature of a simplification, deals with contributions and sales to joint ventures. So the requirement to defer and amortize a portion of the gain on the contribution or sale of assets to a joint arrangement that does not relate to the cash or fair value of other assets received has been eliminated. So that gain would now be recognized in net income to the extent of the interests of unrelated investors, just providing some additional simplification to what was there previously in Section 3055. So this next slide really explains the key change that I pointed out on the earlier slide in terms of what's changed in terms of the accounting for the different types of joint arrangements. So as I mentioned, there's three types of joint arrangements: jointly controlled assets, jointly controlled operations, and jointly controlled enterprises. So, and they're shown in the three green bars across the top of the slide. Now, jointly controlled assets and jointly controlled operations are similar in that both of them operate without a legal entity, so they don't operate in a partnership or corporate structure. But, starting with jointly controlled assets, they're arrangements that usually involve joint ownership and always joint control over an asset directly. So, for example, two enterprises might jointly control a rental property, each taking its share of the rents received and bearing its share of the expenses. And as a result, under the new standard, the investor would recognize its share of the jointly controlled asset its share of the liabilities, and its proportion of the revenue from use of the asset, and as well as its share of the expenses. In terms, if you move towards the middle of the slide, jointly controlled operations is the second type of joint arrangement, and that really generally involves each investor using its own assets and resources which it contributes to the joint arrangement's activities. So, for example, you could have two parties entering into a joint arrangement where one party agrees to manufacture product and the other party agrees to market and distribute the product. In such an arrangement, each of the parties would still retain their own assets, but would enter into a joint arrangement where they would jointly control the activities of this particular venture. And as a result, each would account for the assets that it controls, the liabilities it incurs, as well as its share of the revenues and expenses incurred. So the important point really to take away with respect to jointly controlled assets and jointly controlled operations is that entities will no longer have the choice to use the cost or the equity method. For these types of joint arrangements, the investors have rights to individual assets and obligations for liabilities and would be required to present them in their financial statements. Now, this accounting may be similar to proportionate consolidation accounting for those of you that use that in Section 3055, but may produce different results depending on the details of the joint arrangement, in particular the details of their rights to specific assets and obligations for specific liabilities. Now, the third category off to the right is jointly controlled enterprises. So for those, an entity has more choices available. An entity is allowed to account for all interests in jointly controlled enterprises using the cost or the equity method. The new standard also permits but does not require an entity to undertake additional analyses of its interests in all jointly controlled enterprises to determine whether it has an interest in net assets or individual assets and liabilities. And that's really the key, that when you, if you elect to go down that route and do the analysis, it really needs to be applied to all jointly controlled enterprises. So when that analysis results in an investor determining that it has an interest in a jointly controlled enterprise that represents an interest in individual assets and liabilities, the investor is required to account for that interest in each of those assets and liabilities, very similar to the accounting for jointly controlled assets and operations. If, however, the investor has an interest in net assets, it would account for all such interests using the cost or the equity method. So the key points are really those that I've mentioned, and they are highlighted in gray at the bottom of the screen. If we move to the next slide, this really deals with the analysis of an interest in a jointly controlled enterprise. And for those of you that have applied IFRS, this flow chart, or at least aspects of it, will be familiar to you. So I'll just again, this applies where an investor chooses to analyze its interests in jointly controlled enterprises, and I'll just walk you through what the decision tree is really saying. So the first question to ask is, does the legal form of the jointly controlled enterprise give the investor rights to the assets and obligations for the liabilities relating to the jointly controlled enterprise? If no, you'd move down the decision tree and ask whether or not any of the terms of the contractual arrangement specify that the investor has rights to assets and obligations for the liabilities. If not, you consider additional or other facts and circumstances that are really focused around how the investors have chosen to design the jointly controlled enterprise. So if the design is such that its activities are primarily aimed to provide the investors with an output so that they have substantially all of the economic benefits of the assets held in the jointly controlled enterprise, and it depends on those investors on a continuous basis for settling its liabilities, then you would have rights to assets and obligations for individual liabilities of the jointly controlled enterprise. So at any point, if either the legal form or the terms of the contractual arrangement or the design give the investor rights and obligations, then that's effectively what it would be accounting for. If not, and the answer to all of these is no, then the investor has rights to the net assets of the jointly controlled enterprise. So I'm just going to touch on two aspects of the flow chart. In terms of the terms of the contractual arrangement, you may have a contractual arrangement that may specify that the parties to the joint arrangement have right, title, or ownership to one or more of the assets in the joint operation. However, in other cases, a contractual arrangement may be clear in establishing that the assets brought into the jointly controlled enterprise or subsequently acquired by that are assets of the jointly controlled enterprise itself. And each of those different scenarios can have different implications for the accounting for the jointly controlled enterprise. In terms of other facts and circumstances, when the activities of the jointly controlled enterprise are primarily designed for the provision of output to the investors, this is an indicator that the investors have rights to substantially all of the economic benefits of the assets of the jointly controlled enterprise. And the investors to such arrangements often ensure their access to these outputs provided by the jointly controlled enterprise by preventing the arrangement from selling its output to third parties. The effect of a jointly controlled enterprise that has such a design and purpose is that the liabilities incurred by the jointly controlled enterprise are in substance satisfied by the cash flows received from the investors through their purchases of the output. So when the investors are substantially the only source of cash flows contributing to the continuity of the operations of the jointly controlled enterprise, this indicates that the investors also have an obligation for the liabilities. And those circumstances together would be more indicative that the investor would have rights to assets and obligations for the liabilities of such an arrangement. So we're going to switch gears a little bit into Section 1591, dealing with subsidiaries. And this slide, which is similar to that prepared for joint arrangements, really tries to highlight what is changed in standard. So in terms of what is a subsidiary, the basic definition being an enterprise controlled by another enterprise that has the right and ability to obtain future economic benefits from the resources of the entity and is exposed to the risks is essentially the same. The definition of what constitutes control, being the continuing power to determine strategic operating, investing, and financing policies without the cooperation of others, is still the fundamental definition that's been carried forward into the new standard. What is different, though, is the guidance with respect to the accounting for enterprises where control may be exercised through means other than voting equity interests. So there's more judgment introduced in terms of when control can exist through means other than voting equity, and additional guidance has been provided on the types of contractual arrangements that might give control, as well as other facts and circumstances to consider when assessing control. Now, the accounting policy choices for accounting for subsidiaries remain in that all subsidiaries can be consolidated, or an entity can account for subsidiaries that are controlled by voting interests, potential voting interests, or a combination thereof using the cost or equity method, and those that are controlled through contractual arrangements in accordance with the applicable handbook section. So in terms of control through means other than equity interests, the standard provides that an entity has control through contractual rights when it holds rights that are sufficient to direct the strategic, operating, investing, and financing policies of the enterprise without the cooperation of others, and the entity has the right and ability to obtain the future economic benefits and is exposed to the related risks of the other enterprises. So the same general principle is applicable to entities controlled through voting equity as to those controlled through other means, but there will be more judgment exercised in terms of evaluating entities that are not controlled through equity, which will be very different than the prescriptive approach and more calculation-intensive approach that was provided in Accounting Guideline 15 for determining whether or not to consolidate a variable interest entity. So just to highlight this guidance on evaluating whether an entity controls an entity through means other than voting equity would apply regardless of whether or not consolidated financial statements are being prepared. So the next slide really highlights the different types of contractual arrangements that an entity would consider in determining if it has control over another entity. And this would be anything from supply agreements, management agreements, license agreements, royalty contracts, finance agreements, and lease arrangements. So for example, an entity may find that by virtue of a supplier arrangement, it may have the right to unilaterally direct another enterprise to manufacture goods solely for its consumption. The directing entity would consider all facts and circumstances in terms of determining whether this particular type of arrangement will confer control. So for those familiar with ACG 15, this analysis will look and feel very different, as it's not dependent really on classifying the other entity and whether or not it's a variable interest entity and whether the entity is the primary beneficiary, but really looking at the nature of contractual and other arrangements, including potential voting equity interests that may be in place between the parties, and assessing whether control exists in that manner. So just to provide a little bit more context on the different types of considerations that exist when evaluating whether contractual arrangements are sufficient to give control. One of the things that an entity would look at is the degree of involvement it has in determining the purpose and design of the other enterprise. So being involved in the design alone isn't sufficient to give control, but could give an entity the opportunity to obtain rights that are sufficient to give control. It's important also to look at how decisions are made that could affect whether the entity has the right and ability to obtain future economic benefits and is exposed to the related risks of the other enterprise. So, for example, an enterprise may be designed so its activities, its future economic benefits, and its exposures to risks are predetermined. So in that case, an entity would evaluate whether it has decision-making authority when those particular events or circumstances occur, which may confer control. It's also important to assess the risks that the other enterprise is designed to be exposed to, and that can include anything from operating risks, price, credit, liquidity, and interest rate risks. And also whether to return to the main principle, whether the entity has the continuing ability through a contractual arrangement to direct those strategic policies of the other enterprise without the cooperation of others. So this evaluation of the rights would include a number of rights, including those put in place at the inception of the arrangement in the form of call rights, put rights, liquidation rights, and rights that may only be exercisable when an event or circumstances occurs, as may be the case for certain entities on autopilot or on a predetermined path. So with that, I will turn it back to Jen.
Thank you, Deanna. And now we will move on to our second polling question of the day. Does your organization intend to early adopt the changes made to accounting for subsidiaries and or joint arrangements? A, no, we will not early adopt. B, yes, we will early adopt. C, we haven't made a decision at this time. Or D, not applicable. And Deanna, while we wait for the results of the polling question, I'd like to ask you a question that has come in. For the situation where an entity is no longer able to use the cost or equity method and is required to account for its interest in the assets and liabilities of the joint arrangement, does it have to apply the new accounting on a fully retrospective basis?
Thanks, Jen. The short answer is no, that there are certain transitional provisions available within the standard. So an entity would have the choice to fully retrospectively apply Section 3056, or it can use the carrying amount of assets and liabilities in the financial statements of the joint arrangement at the beginning of the year prior to adoption of the standard, so the beginning of the comparative period, or there's also an option to use the fair value of assets and liabilities in the joint arrangement on the same date. So fully retrospective is one of the options, but not the only one.
Great, thank you. And now if we can look at the results from our polling question. Okay, so for 50% of the people not applicable, 28% have not yet made a decision, and 17% no, and a very small percentage of people have made the decision to early adopt. Interesting. It's always kind of neat to look at the benefits of early adoption, think about the users. Sometimes there are real benefits, and it is a big decision. And with that, I would like to welcome our next speaker, John Klingman. John is a partner in the Canadian National Office. He has been with Deloitte for over 27 years and is a member of the Technical Consultations Group in National Assurance and Advisory Services. John specializes in a number of IFRS and ASPE technical accounting topics, in particular accounting for income taxes, foreign currency translation, related party transactions, and business combinations. He is also a facilitator for technical training. And with that, I will turn it over to John.
Thanks, Jen, and hi, everyone. The annual improvements process clarifies guidance or wording, and it also corrects relatively minor unintended consequences, conflicts, or oversights. The 2014 annual improvements incorporated two changes to Section 3856, and they're effective for fiscal years beginning on or after January 1st, 2015, with earlier application permitted. There's also one proposed amendment that didn't make the cut, and we'll talk about that one too. So the first change to the financial instrument section relates to hedging. And the question is, well, what happens if a hedge transaction and settlement of the hedging item straddle the balance sheet date? The amendment clarifies that the hedging item is remeasured at year-end, and any gain or loss since the date of the hedge transaction is included in income. Now let's look at the example on this slide. Suppose that HedgeCo purchases equipment in U.S. dollars before year-end, and prior to the transaction, it purchases a foreign exchange forward contract to hedge the purchase of the equipment. The contract is settled, and the equipment is paid for after year-end. So the gain or loss on the FX forward up to the time the equipment is purchased on December the 20th is included in the cost of the equipment. The FX forward is then remeasured at the balance sheet date at the spot rate at that time, so that the gain or loss on the forward between the date of the equipment purchase, December the 20th, and the year-end, December 31st, is included in net income at year-end. If the payable is settled at the same time as the FX forward on January the 15th, the gain or loss on the forward at year-end and post-year-end will partially or completely offset the loss or gain on the payable during those periods. The second annual improvement related to the financial instrument section relates to financial asset impairment disclosure. The box on the left, the blue box on the left, represents the old requirement, and the green box on the right is the new requirement. The general rule is that you're to disclose the carrying amount of financial assets that are impaired by type of asset and the related impairment allowances. Under the amendment in the green box on the right, there will be an exception for current trade receivables. For those, you only have to disclose the amount of any allowance for impairment. You don't have to disclose the carrying amount of those current trade receivables that are impaired. And the reason for that change is that for trade receivables, the allowance for impairment is often determined as a group based on the age analysis or some other methodology rather than on an item-by-item individual receivable basis. So the allowance for impairment might not relate to a specific item or items, and the related carrying amount of the impaired receivables or receivables might not be determinable because the allowance relates to a pool of receivables. Okay, now to the item that did not make the 2014 improvements cut. That relates to Employee Future Benefits, Section 3462. That section includes an option for an entity to use a funding valuation to determine its defined benefit obligation for an unfunded benefit plan. The wording as it currently reads is unrestrictive, and entities are not precluded from going out and getting a funding valuation if they don't already have one. The reason for providing the option to use a funding valuation was to reduce actuarial costs for those entities that were already preparing funding valuations for regulatory purposes, so they weren't also required to go out and get a separate valuation for accounting purposes. The 2014 Annual Improvements Exposure Draft proposed to limit the option to use a funding valuation for unfunded defined benefit plans to entities that have at least one funded defined benefit plan. The proposed amendment was not approved, and no changes were made to the handbook in this area as a result of that. Respondents to the exposure draft and the Accounting Standards Board agreed in principle with the proposed amendment, but in light of concerns raised by some stakeholders and the board regarding clarity of the amendment and other issues, the Accounting Standards Board decided to consider the issue further before issuing final changes. As Jen noted at the outset, Claire will have more to say about Section 3462 a little later on in the webcast. And just to note that if you subscribe to the publication, The Standard, the one you received probably last night or overnight or early this morning includes an FYI article and the basis for conclusions about these annual improvement changes and this particular non-change. Okay, switching gears and moving to future changes headed our way. On the next slide, you'll see the Accounting Standards Board project plan for ASPE. And you'll find that on the Standards Board's website, frascanada.ca. And of course, that does get amended from time to time. So it's a good idea to regularly check the website if you want to see the current status of projects. So just running down the projects in the column on the left, the first one, the Accounting Standards Board Strategic Initiative, that project's going to be used as a basis for developing the ACSB's next strategic plan. It takes a closer look at each of the accounting frameworks used in Canada and whether or not they're working as intended and meeting the needs of users, and how to better implement the strategies. And as you'll note, that strategic initiative is not limited to ASPE. It's a broader project. The next one, annual improvements for 2015, those issues are currently being identified, and we don't know what they are yet, but the employee benefits issue that we just talked about might find its way into that project. The next one, now we get to the major projects. The next one is agriculture, and that's a long overdue project. Among the things that that's going to address are when should a biological asset be recognized, how should it be measured on initial recognition, how should it be measured in subsequent periods, and how should agricultural produce at the point of harvest be accounted for. The next project you'll see on your slide is the redeemable preferred shares issued in a tax planning arrangement. We have separate slides for that, so I'll skip over that for the moment and go to the subsidiaries one. Sections 1590 and 1591 provide an accounting policy option for private companies to either consolidate their subsidiaries or account for them using the equity method or the cost method. This project is going to look at whether certain aspects of Section 1582 on business combinations should apply when a private company chooses to account for its subs using the cost or equity method. It's likely going to address things like, should transaction costs and contingent consideration under the cost and equity methods be accounted for in the same way as under Section 1582? What about the impact of pre-existing relationships? Should Section 1582 accounting apply under the equity method for things like bargain purchases and use of a defined measurement period for completion of the purchase equation? Of course, the latter items depend on what's going to happen with equity method accounting. We also have separate slides on the post-implementation review of Section 3856 on financial instruments, and we'll get to that in a few minutes. So moving on to really a major item, and that's redeemable preferred shares issued in a tax planning arrangement. And this one really is a big one and could have a significant impact for some companies. The status quo, the current requirements, are in the box, on the blue box on the left-hand side of your screen. The proposal is really is outlined in the green box on the right-hand side of your screen. The Accounting Standards Board is proposing to remove paragraph 23 in section 3856. That paragraph requires redeemable preferred shares issued in certain tax planning arrangements to be classified as equity and recorded at their par stated or assigned value. When redemption is demanded, they are reclassified to liabilities, and tax planning arrangements that are meant to be captured by that guidance includes estate freezes or other rollover arrangements. Now, just removing one paragraph won't sound like much, but the implications can be huge for both classification and measurement of these instruments. So if paragraph 23 is removed, and if you just look down the items on the right-hand side of your slide, you'll see that the preferred shares would be classified as liabilities. They would be measured at their initial fair value, which would usually be their redemption amount, and that would usually equal the fair value of the business at the date the shares are issued. The corresponding impact would be a reduction in shareholders' equity, and the charge would be reflected in a separate component of equity and reclassified to retained earnings when the shares are redeemed. The negative impact on shareholders' equity was the determining factor for including paragraph 23 in the handbook in the first place. There was concern that financial statement users would be confused and led to believe that profitable entities were actually doing poorly. The Accounting Standards Board's current research indicates that's not a problem anymore. They also believe that showing the charge in a separate component of equity should help. So let's look at an example outlined on your screen. Joe wants to pass his business onto his children on a tax-deferred basis. So he uses a Section 85 rollover to transfer the business and in exchange receives preferred shares at a nominal amount of $1, but they're redeemable at the fair value of the business of $1 million, and their current fair value is $1 million. Under current accounting, with paragraph 23 in section 3856, the preferred shares would be recorded in equity at $1, but there would be disclosure around the terms of those shares, in particular disclosure around the redemption amount. Now, moving to the proposal, if paragraph 23 is removed, those preferred shares would be recorded as a liability at their initial fair value, which would equal the redemption amount. So that $1 million would show up as a liability, and there would be a corresponding charge to a separate component of equity. So you have, under the proposal, a significant immediate hit to equity. Comments on the exposure draft are due on January 15th, and hopefully several members of our audience will respond to that. When you draft your response, you might want to think broadly in terms of the impact on financial statement users, agreements, covenants, tax implications, and so on. You know, like what are the potential risks and costs associated with this change? Could appropriate and detailed communication with financial statement users alleviate confusion or misconceptions? Are there compelling arguments to treat redeemable preferred shares issued in tax planning arrangements differently than shares or instruments issued with similar terms and conditions but in other circumstances? According to the commentary in the exposure draft, some thought that if these shares are recorded as liabilities at the redemption amounts, there could be adverse consequences for the availability of the small business deduction. The Accounting Standards Board said that they've consulted with tax experts who've informed them that there would be no adverse consequences. If you're aware of any potential adverse tax consequences or any other negative implications for that matter, now's the time to advise the Accounting Standards Board because they don't think there are any problems. If you'd like more info on this project, You might want to have a look at the webinar that CPA Canada put out on this. It's an excellent webinar. I think it's only about an hour. You can access it on the FRAS Canada website, and it is very transparent. They set out exactly all the research they've done, what they know about it in terms of problems or potential problems, and they say, let us know if you're aware of any additional problems that we have not identified. Okay, moving on to the post-implementation review of Section 3856, Financial Instruments. This will assess the effect of the standard on financial statement users and preparers. I'm not sure, but I think it might be the first post-implementation review project for an ASPE standard. It's going to consider whether the standard has achieved its intended objectives and whether there are any unexpected costs or implementation problems that have been encountered since the standard was published. Comments are due on February the 9th. The document poses 11 specific questions on the subjects listed on your screen. Some examples regarding initial measurement. Are there challenges in practice in determining the initial fair values of financial assets and liabilities? For what kinds of transactions is determining fair value difficult? Regarding related parties, if you just go down a couple of bullets, are there challenges in determining whether to apply Section 3840 on related party transactions or Section 3856, financial instruments, to aspects of accounting for financial assets and liabilities besides initial measurement? If you go down a couple more bullets, presentation of liabilities and equity, are there challenges in applying the guidance to determine whether an instrument should be classified as a liability or equity? Are there challenges in determining whether an instrument contains both a liability and an equity element? Are there any problems in accounting for compound instruments? This is a great opportunity to provide input on what's not working and areas that you might find confusing or difficult to interpret. So let the standard setters know where there may be warts. And at this point, I will turn the microphone back to Jennifer.
Thank you, John. And we are going to now do our third polling question. What are your initial thoughts on the proposal to remove the exception in Section 3856 for redeemable preferred shares issued in a tax planning arrangement? Completely agree, completely disagree, indifferent, or not applicable? And John, while we wait for the results of the polling question, I would like to ask you a question. Your slide on redeemable preferred shares indicates that those shares should be measured at fair value. Does that mean that at each balance sheet date, the carrying amount would have to be adjusted to the current fair value? Okay.
Those shares are usually redeemable for a fixed amount based on the fair value of the company at the date that they're issued. Under Section 3856, they have to be recorded at their initial fair value when they're initially recorded. But usually they're redeemable at any time. So as long as they're still outstanding, the redemption amount and the fair value will be the same at any balance sheet date. So no adjustments required. An exception might occur in situations where the redemption date is deferred to a future date, a specific future date, or maybe where the shares are subordinated to another instrument, meaning they can't be redeemed until another debt instrument, for example, is repaid. In those latter cases, the redemption amount would be discounted and accreted over the term to the earliest possible redemption date.
Great, thank you. And with that, let's look at the results of our polling question. Okay, so we have 30% not applicable, 30% roughly indifferent, 28% completely disagreeing, and 11% in complete agreement. So that is interesting. And I think it's going to be interesting to read the detailed comment letters that come back to the Accounting Standards Board staff when they are made available later in January 2015. And with that, I'm going to move on to our fourth polling question for today's webcast. Do you intend to respond to the post-implementation review request for information on Section 3856 financial instruments? Yes, there are issues I would like to raise. No, Section 3856 is working just fine. no, there are issues, but I can't be bothered to respond, or not applicable to me. And while we wait for the results of that polling question, John, I'd like to ask you another question. I noticed on the slide related to the post-implementation review of Section 3856 that the post-implementation review is going to address hedge accounting. Any chance that they'll broaden hedge accounting under ASPE to accommodate more hedging scenarios?
Okay, thanks, Jen. 3856 currently limits hedge accounting to certain specified scenarios, and I thought that those scenarios would be ones that would be common for privately held companies, and those are usually related to anticipated transactions denominated in foreign currencies, using interest rate swaps to hedge interest-bearing assets and liabilities, hedges of net investments in self-sustaining foreign operations. In fact, one of the questions asked in the post-implementation review document is whether hedge accounting should be permitted for additional types of hedging scenarios. They want to know how common some of those other scenarios are in practice. So depending on the input received by the Accounting Standards Board, they might consider additional situations, but there are no guarantees. So we'll have to wait and see. But before turning it back to you, Jen, I want to say that I find the results of your previous polling question very interesting. 28% of our viewers think there are problems. I think you guys should respond very clearly to the Accounting Standards Board, because if you listen to the webcast or the webinar that they did, which is excellent, they lay out all the issues they think they've identified. It sounds like there may be others that they may not be aware of, so please do your best to respond, because you may not have another chance. Sorry for the digression, Jen, but I like
No, that's great.
I like the response.
Good. Okay, and with that, let's look at the results of our last polling question. Okay, so we have 57% not applicable, which seems high. 22% working fine. 3.4% saying there are issues they would like to raise, which seems low, and 16% saying there are issues, but I can't be bothered. And I guess with that, I go back to John's earlier comment around this is a great opportunity to provide our input, have our say, and influence the future direction. So it would be unfortunate not to respond, especially if you have issues with this action. And with that, I would like to turn the presentation over to our last speaker, Claire Grindley. Claire is a partner at Deloitte's national office and a member of both the Technical Consultations Group for the Canadian firm and a member of Deloitte's global IFRS team. Subjects of focus for Claire include employee benefits, impairment, and joint arrangements, and she is also a member of the IFRS Discussion Group, a subgroup of the Canadian Accounting Standards Board. And with that, I will turn it over to Claire.
Thanks very much, Jen, and hi, everybody. So I'm going to spend the next little while talking about employee future benefits implementation. Interesting to see on the last polling question that around 23% of the group listening in today were satisfied with 3856. I'm kind of curious myself to know what portion might be satisfied with 3461, the predecessor to the new employee future benefits standard. I suspect there may be a portion of the group that would have said the standard should have remained unchanged, but it hasn't. And I'm going to go through some of the changes that have occurred under 3462. And I hope you'll see from this part of our presentation to you that while some policy choices have been removed, there are actually some practical expedients that have also been introduced by the new standard. So Section 3462, Employee Future Benefits, the replacement to Section 3461. And as the name suggests, this covers employee benefits that are payable in the future, so beyond the current service period. The classic example that one might think of is pensions, but it could also be termination benefits and other long service benefits payments that are payable to employees. Now, this standard is effective this year, so for fiscal years beginning on or after January 1st, 2014. So for those of you who've got December 31st year ends, then December 31st, 2014 will be your year of initial adoption of 3462, unless, of course, you did decide to early adopt. Now, Section 3462 did result in some changes and hopefully does bring with it some benefits. And the benefits that have been outlined with respect to the standard are increased comparability between entities through the elimination of certainly one significant policy choice, a more meaningful balance sheet number, and then also depends how you view this one, increased income statement volatility. For that's perhaps not considered to be a benefit, but it does give transparency to the users of the financial statements as to what's happening with the defined benefit plans. So let's move on to the next slide and going to start going through some of these changes. And the changes for the most part under 3462 do relate to the treatment of defined benefit plans. This could include pension plans, but it could also include other benefit plans that you've got in place as well. Now, one of the complexities associated with defined benefit plan accounting relates to the need to get actuarial valuations to measure the obligation and then the treatment of the corresponding actuarial gains and losses that arise. And actuarial gains and losses are effectively differences that might arise because long-term assumptions, say, differ from short-term experience. And in the past, under 3461, there was a policy choice that enabled entities to defer and amortize these gains and losses over an extended period. But this policy choice has been removed now, and as a result, the only option available to all entities is to effectively bring the full surplus or deficit that relates to the pension plan or defined benefit plan onto the balance sheet. So as noted on the last slide, this will result in increased comparability, but for those entities out there who do have significant actuarial gains and losses, then this could be a big change as to the look and feel of your balance sheet. Now, the resulting number that falls out of this will be presented as a net number on the balance sheet, referred to as the defined benefit liability or asset, depending on what the net position is. And at the bottom of this slide, you can see the components that make up that amount. And you'd have at the start the defined benefit obligation. So that's the number that's a present value number that comes from your actuary and comes from an actuarial valuation. And that will be a credit balance, an obligation. And then you'd have the debit balance, your asset being the fair value of pension assets. That assumes, of course, that the plan in question is funded. And then the difference between the two might give you a surplus if plan assets are more than the obligation, or a deficit if the converse is true. There is one final adjustment that's made to that before we get to the net amount that's presented under 3462, and that's a valuation allowance. So this might apply if the fair value of your pension assets is in excess of your defined benefit obligation. So you've got a surplus, you're in a surplus position presenting a net asset. There is a requirement in the standard to do a recoverability test in the same way you might do for your accounts receivable or your tax assets. And sometimes that results in the need to do a write-down. So where that's true, then that's also deducted. And then the final number is your defined benefit liability or defined benefit asset. So looking at what's changed, I'm going to focus on a few things here. One that's of note is the elimination of the 3-month window. So you might remember before that the standard included a 3-month window that allowed an entity to measure the plan obligations and plan assets at a time period before the balance sheet date. So this might be if you're a December 31st year end, you could have chosen to go as far back as September 30th to measure your plan assets and plan obligation. And sometimes for those entities out there with tighter reporting deadlines, this was certainly a helpful allowance in the standard. So it might be disappointing for entities to see that this 3-month window has gone away, and instead the obligations and assets do have to be measured at the balance sheet date. Now, don't fear too much, because there is another change that the standard brings with it that I'm going to talk about shortly as well, and that takes a little bit of the stress out of the elimination of the 3-month window. The discount rate is at the date of the actuarial valuation, and actuarial valuations need to be done at least every 3 years, sometimes more frequently when a significant event occurs. And the discount rate, as with 3461, is determined by reference to high-quality corporate bonds. So nice to see that something stayed static there. The biggest change that we're getting questions about is a policy choice that's been introduced, and it's introduced to provide a practical expedient to entities that'll perhaps result in some cost reductions for you. So this is good news, and this is a policy choice that's available with respect to using either an actuarial valuation prepared for funding purposes or an actuarial valuation prepared specifically for accounting purposes. So let's have a think about what this means. If you think in the past, you would have typically asked your actuary to prepare a specific valuation for accounting purposes because the accounting rules required it. And this would be on top of the valuation that your actuary was already doing for funding purposes, because all regulated pension plans in Canada have to have a funding valuation performed. What this policy choice introduces, it says to entities, well, you don't have to go and incur those extra dollars and get this separate accounting valuation. You can choose just to use your funding valuation instead. And that's a pretty helpful choice from a cost perspective, certainly. And it also, as I noted, perhaps takes some of the stress out of the elimination of the 3-month window. And we will touch on that a little bit more with a related slide that's going to follow. But in terms of the choice that is made, you must remember, though, that it's got to be applied consistently to all of your funded plans. So if you've got 2 or more funded plans, you make the policy choice to use the funding valuation that you've already got, or go out and get an accounting valuation for all of your funded plans. You don't cherry pick which ones you're going to do it for. The last item I'm going to mention on this slide relates to the actual return on plan assets. We no longer in ASPE have the notion of the expected return on plan assets, but the actual return on plan assets is one of the components that goes into the overall benefit cost that's included in your financial statements. It is, of course, a positive number that reduces your overall benefit costs. And the note that's made here on this slide is that the cost of managing plan assets paid for by the sponsor are deducted from the actual return on plan assets. And that's separate and distinct from, say, any administration cost. It's got to be the cost of managing plan assets. I think I'd like to go to the next slide now, which helps put some of what I've just been saying into a bit of a better context. And here we can look at some of the components of cost and presentation that relate to a defined benefit plan. There's 3 components, and for those of you who've got some familiarity with IFRS, these components do actually mirror IFRS to a large extent. The key difference relates to the last item, remeasurements and other items, which have some different components to IFRS. And also, because under ASPE we don't have the concept of other comprehensive income, all of these costs are going through your P&L. So item 1 is current service cost, and this is the actuarial present value of benefits attributed to employee services in the period. And that's shown net of any contributions that you receive from your employees. The second component is the finance cost, and this is a net number, and this is determined by looking at the defined benefit liability or asset at the start of the period, and that's applied to the discount rate in order to determine the overall finance cost that goes into your P&L for the period. The last item covers a bit of a mishmash of items. The biggest component for many entities will be the actuarial gains and losses, which I referred to previously. So this is a number that perhaps will introduce some volatility to your financial statements. In addition to actuarial gains and losses, you're also going to see in there the difference between the actual return on plan assets and the amount included in finance costs, changes in the effect of any valuation allowance, past service cost, and then lastly, gains and losses on settlements or curtailments. And just to note there that you can choose to show remeasurements and other items either as a separate line item on your P&L or as a separate item that's disclosed in the notes to your financial statements. I'm going to go through a few questions that you might already be thinking of as you listen to this webcast, or perhaps already been talking to your auditors and advisors about. And these are all questions that are based on this new policy choice to use a funding evaluation as opposed to an accounting valuation. And one question you might ask is, well, when is a policy choice to use a funding or an accounting valuation available? And John did talk to this a little bit earlier on to note that this is an item that's under discussion right now by the Accounting Standards Board. It's certainly a policy choice that's available for entities that have got funded benefit plans. And it's also available if you've got a unfunded benefit plan and also one or more funded plans. The question that arises is, well, what happens if I've just got some unfunded benefit plans? Can I use a funding valuation then? And how do I do that given that it isn't funded? I think if you do have that question, we'd advise you consult with your auditors and advisors, and we can best direct you how to proceed in that area, given the flux in this matter by the Accounting Standards Board. What are the differences between a funding and accounting valuation? Well, both are prepared for two discrete purposes. The funding valuation is prepared in order to look at whether or not there's enough assets in the plan to fund the benefits that are payable to the members. And that's based on a specific set of assumptions that actuaries are bound to use for those funding valuations. And those might differ from the estimates that are used under the accounting rules and are a part of 3462 for accounting valuations. So you could get quite a different obligation in your funding valuation versus an accounting valuation. And so if you are looking at that policy choice, it might be a good idea to ask your actuary, well, what difference is this going to be to me? How much money am I going to save in terms of the cost of preparation, and what's it going to do to my numbers? And they should be able to give you some kind of high-level analysis. The other question that I'm going to mention here is, well, what's considered to be the most recently completed actuarial valuation? And you might remember I mentioned a couple of slides ago that there's the elimination of the 3-month window and the fact that that might cause some stress for some entities because they might worry that their valuation hasn't been completed in time for year end. Well, ASPE is a little bit friendly in this regard in that it says to you, you can use whatever your most recently completed actuarial valuation is, as long as you're getting those valuations done at least every 3 years or when a significant event occurs. So even if your actuarial valuation is still in progress when you need to get your financials issued, you can just use your most recently completed actuarial valuation, and that might be the last one that the actuary did and filed with the regulator. There are some questions that arise in terms of, well, what constitutes most recently completed? So if you are in doubt, it might be best to give us a call. One side note there as well is from a disclosure perspective, there is a requirement to disclose the actuarial valuation that is the basis for the numbers in your financial statements and when it was done. So that's quite a helpful piece of information perhaps for your users as well. Just going to talk a little bit before I close off on employee benefits about some new things that are happening in the pensions environment. And this is the shared risk pension model. Let's pull up that slide, please. Okay, we've got a couple of slides on this. You can see a bit of a seesaw here supported by a green Deloitte triangle, I guess. And some of you might have heard, it's been quite a public matter for those people interested in pensions, that there are issues with defined benefit plans because there's a lot of significant deficits out there and question marks as to how those deficits are going to be funded. And this is resulting in lots of entities moving away from defined benefit plans into defined contribution plans. But for those who already have defined benefit plans in place, it's causing some entities to look for solutions. And one solution that's been floated is the shared risk plan. And this is a pension model that aims to share the risk more equitably between the employer or the plan sponsor and the plan members. This is really taken off in New Brunswick, where the legislation was amended to enact the concept of a shared risk pension plan. And we do have a number of entities that we've been working with in New Brunswick who either have moved or are considering moving to the new model. Let's just kind of take a look before I close off here as to what a shared risk pension model is for those who want a bit more detail. And that's on the next slide, thanks. Okay, so I'm going to just go through the bullets down the bottom and then I'll finish with a word on classification. So pension plans are generally classified as DC, defined contribution, or DB, defined benefit. And a shared risk plan has characteristics that have a bit of both, really. And an employee and employer contributions are set at a base level, but then they might go up or down depending on the funding position of the plan. Usually there's a stipulated range. It might be 2%, let's say. Sometimes it's as low as 0.5%, but employer and employee contributions are subject to variability. That's a key thing to note here. Now, benefits aren't generally guaranteed, although sometimes an entity does put in place a guarantee that guarantees benefits that have accumulated up to the date of conversion. That gives the existing pensioners certainly a high degree of comfort. But otherwise benefits aren't generally guaranteed, and a target benefit is set, and the funding of the plan is measured, and contributions vary with a view to trying to reach those target benefits, but not providing a guarantee that will be done. That said, the probability of meeting those target benefits is generally very high. I think in the New Brunswick legislation it's 97.5% or higher. In terms of how these are classified, the accounting rules don't specifically address these types of plans, but we're seeing most of these being classified as defined benefit plans. But certainly if you do go down this route, it's an item you'd want to have early conversations with your auditors and advisors on. And when I say early, I would say when your actuary is talking to you about these, involve us as well so you don't get any surprises down the road. And Jen, I think that's it from me on the subject of employee benefits for now.
Thanks, Claire. We've got another polling question here. How would you describe your entity's transition to Section 3462, Employee Future Benefits? A, straightforward. B, more difficult than expected. C, difficult with lots of questions. D, in progress, so not yet sure. Or E, not applicable. And Claire, while we wait for the results of the polling question, I'd like to ask you a question that has come in.
Okay.
Do you have a sense in terms of whether most entities are taking the option to use the funding valuation, or are they going to stick with the accounting valuation?
Yeah, I do, Jen, and based on those who've reached out to us or who we've been in dialogue with, there's a lot of interest in the funding valuation. Entities are doing this for a couple of reasons. One's to save costs, as I said in my presentation, and the other is it gives a bit less confusion. Like, entities have talked about the fact that in the past it's been difficult to explain to their stakeholders why they've got one set of pension numbers in the pension plan financials and then they've got this number in entity financials that's quite different, and that takes some of that mystery away. So funding valuation appears to be the policy of choice at the moment.
Great, thank you. And with that, let's look at the results from the polling question. Wow, okay, 75% not applicable, just over 4% found it straightforward, and 11 in progress, 6, 7, 8% more difficult or difficult with lots of questions, which doesn't come as a big surprise. It seems that for many, the implementation wasn't quite as straightforward as expected. And with that, Claire, I think it's back over to you for some year-end reminders.
Thanks very much, Jen. And I must say then thank you to the 75% who employee benefits wasn't applicable for. I'm actually very grateful for the fact that you stayed with us. So let's hope these year-end reminders, which I would say have broad applicability, are going to be helpful to you. And unlike Section 3462, these aren't new items, but these are items that we're seeing that are topical and we're encountering frequently in practice. So we wanted to give you a final reminder as you start thinking about your year-end annual financial statements. And the first one's classification of debt. Okay, so here we go. Okay, so this is looking at situations where you've got long-term debt and there's covenants attached to debt, and banks generally like to attach covenants to debt. And this is a reminder that, and this is from Section 1510, by the way, of the handbook, if you've got long-term debt with a measurable covenant valuation, then this is classified as a current liability unless, firstly, the creditor is waived in writing or lost the right to demand repayment for more than 1 year from the balance sheet date, or the debt agreement contains a grace period and contractual arrangements have been made to ensure violation will be cured during the grace period. So it's kind of step one. So let's pause there. So you've got to classify it as current unless you've got one of those conditions present. And then the important bit that sometimes people forget in practice is the and here. Future violation of debt covenant, giving creditor right to demand repayment within 1 year is not likely. So in addition to making this assessment at the balance sheet date, which is the first two conditions up above where you've got one of which has got to be satisfied, you've also got to do a forward-looking test. And we'd expect to see some kind of analysis or assessment done by an entity to which this guidance is applicable that demonstrates that future violation within that 1 year period is not likely. And if we move to the next slide, we'll kind of do a little bit more on long-term debt here and these unfortunate situations that entities sometimes find themselves in. And this is a reminder, firstly, that non-current classification has got to be based on facts existing at the balance sheet date rather than expectations regarding future financing or refinancing. So if, say, you've got a situation where you've got some long-term debt and it's due to be renewed in, let's say we're a December year end and it's due to be renewed in March, so 3 months after the balance sheet date. Well, in order to retain your non-current classification, you've got to have that renewal in place at the balance sheet date. You can't have the intent of renewal or the expectation of renewal. It's got to be in place at the balance sheet date. So if you are in that situation and you're looking to get renewal, you might want to get on the phone with your bankers before, or other debt providers before the year's out, just to avoid any year-end financial statement issues. Another question you might have is, well, what happens when a measurable covenant violation doesn't exist at year-end but occurs after year-end? Well, in this case, what we'd say is that factually, at year-end, at the balance sheet date, there is no covenant violation. That said, it's not a do-nothing approach. Some kind of disclosure under the subsequent event guidance would be applicable and required in this case. And then the last point on this slide, well, what happens when there's a covenant violation at the balance sheet date which has been waived? And here we go to section 1510 again, paragraph 14, and a reminder that there is a requirement that the entity assess future compliance with the covenants for a period of 1 year from the balance sheet date. So that's the point that I made on the last slide. Don't forget to do that forward-looking test. And if violation of the covenants is likely within the year, notwithstanding the fact that you got a waiver at year end, then classification would still have to be current. So if you are looking to get a waiver, you might want to look at, well, what happens for the next year? Perhaps the waiver can cover that 1 year period, and see if you can get it appropriately worded by your debt providers to make it crystal clear that grace period does cover that full 12-month period after your balance sheet date. So let's look now onto impairment. And a reminder here of how you might go about testing impairment or evaluating impairment on the various assets that are on your balance sheet. Just to note here that, while under ASPE we don't have requirements for annual impairment tests, it doesn't mean you do nothing. That there is a requirement generally to assess and evaluate whether there's any events or circumstances that have occurred that would require you to do an impairment test. And when you're looking at this, we'd suggest a three-step approach in terms of the different assets that might be on your balance sheet. First, look at assets other than non-monetary long-lived assets. And this might be your inventory, accounts receivable, indefinite life intangibles, and so on and so forth. Then step 2, look at assets which fall under the guidance of ASPE 3063. So that's your PP&E and your finite life intangible assets. And then last but not least, if you've got any goodwill, do that as the final step in your impairment evaluation stage. And as the slide indicates, goodwill is tested for impairment only after all other assets have been assessed for impairment and any identified impairment loss has been recognized in respect of those assets. So if we look to the next slide, this just gives you a reminder of when an impairment loss is recognized and how that is measured. And if you look in the case of intangible assets not subject to amortization and goodwill, then impairment loss is recognized here when the carrying amount of these assets is in excess of fair value. Now remember, for goodwill, this test is done at the reporting unit level. So here the assessment is whether the carrying amount of reporting unit, including goodwill, exceeds its fair value. For other assets, so long-lived assets such as your PP&E and intangible assets that are amortizing, Then you've got an undiscounted cash flow screen, and here you test for recoverability, and you look at your undiscounted cash flows and assess whether or not those are in excess of the carrying amount of your assets. If it is, then you don't have an impairment. But if the carrying amount is not recoverable, so that undiscounted cash flow number is below your carrying amount, then you've got to recognize an impairment loss. And that's measured at the amount by which the carrying amount exceeds fair value. And that's the same for all assets that we've shown on this table here. So if we can move to look at impairment indicators, as I mentioned a couple of slides ago, whilst we don't have an annual impairment test, it's not a do-nothing approach under ASPE. Rather, you do have to look at whether or not there's any events or circumstances that might suggest that you've got an asset that could be impaired and therefore requires you to do an impairment test. And so these are some of the items. As the slide indicates, this list is not exhaustive. So has a major competitor entered the market? Has there been a change in demand for your products that you're unable to respond to? Have interest rates changed or the cost of capital changed for your entity? If you're exposed to foreign exchange, then are there changes in foreign exchange or otherwise also commodity prices that make you more susceptible to impairment? So for assets such as PP&E, maybe there's signs of obsolescence or physical damage that indicate the asset might be impaired. Or maybe you've got changes in your business model or plans to restructure or discontinue part of your operations that again suggest that you might not be able to recover the full value that's reflected on your balance sheet. So make sure either way that you do that screen at least, to test for impairment indicators at year end, and then based on that determine on whether or not you need to do the full test. And before I hand it back to Jen, I just want to do a final check on some other year-end reminders. And this is a bit of a potpourri here that you can perhaps digest it in your own time as well. But things that you might want to think about at year-end. Do I want to change accounting policies? And remember, in some cases, an accounting policy might be required. That was 3462. You don't have a choice there. You've got to change your accounting policy. But sometimes it might be beneficial for you to change your accounting policy. And Section 1506 provides, in some cases, a free choice to change accounting policies without having to demonstrate that the new policy is more reliable or more relevant. Have you reviewed the estimates that are applicable to your assets? And that would include the amortization method and the useful life policies. Tax, can never forget about taxes. And for any of you who've got uncertain tax positions, make sure that you have reviewed those uncertain tax positions so you're clear of a status at year end. And for those of you following the future income tax method, consider the recoverability of the future tax assets. Significant unusual transactions, all I'll say here is that if something significant or unusual, and you can judge what that is for your entity, has occurred, look at whether you've got all of your everything in place for that transaction and you're satisfied with your accounting at the year end. And it might be beneficial if you haven't reached out to Deloitte to just give us a call and make sure there's not going to be any audit issues in that regard. And lastly, financial statement considerations. It's certainly never too early to think about disclosure, and perhaps you've got a draft, a set of your financial statements that are going to be ready early, that it might be helpful for you to just pass on to your auditors to get them to do a quick check on whether or not all the disclosures look to be adequate, and that might include, say, your 3462 disclosures. And Jen, those are my final reminders, so back to you.
Thank you, Claire. We appreciate your feedback. So before we begin our question and answer period, which I think is going to be quite brief today, I wanted to point out that you will notice a red survey icon on the bottom right of your screen. I would kindly ask you to fill this out for development of our future webcasts. We take these surveys very seriously, so please continue to send us your suggestions. And if we don't get to your questions today, which we likely won't, I would recommend that you discuss your questions with your Deloitte contact so that they can respond to any questions or concerns you may have. And with that, I'm going to ask John a question here that has come in, and I believe it relates to the example that you walked us through on the preferred shares. And the question is, the presentation of the liability of $1 million should also be presented in current liabilities as well to keep the nature of fair value.
You bet, Jen. If those shares are redeemable by the holder at any time, and if the company cannot control when they're redeemed, then yes, they are a current liability. So with that huge current liability and the huge charge to equity, it's going to make for a pretty ugly-looking balance sheet.
Great. Thanks, John. And Claire, we have one for you on the shared risk model. The question is, my pension plan is federally regulated. Am I eligible for the shared risk model?
Answer to that one, Jen, is not yet, but you might be in 2015, so stay tuned. The federal government are actually currently evaluating a proposal to change the legislation applicable to federally regulated plans, and this includes the possibility of introducing a target benefit plan model. So stay tuned, and we'll certainly keep you apprised on future webcasts and in future newsletters.
Great, thank you. And thanks again to our speakers, Deanna, John, and Claire. We hope you have found this webcast helpful and informative. If you want additional information, please visit our website at www.deloitte.ca. And to all of you viewing our webcast today, thank you for joining us. This concludes our Bringing Clarity to ASPE Developments. It's that time of year again.